Hello everyone, welcome everyone in our video. You are watching this video in CurrencyHacked.com, and my name is Siva Prasad Bhandari. I'm chief editor at CurrencyHacked.com. You've been watching our video in our YouTube channel, as well as you've been reading the. We believe you've been reading our article in our website to get the idea regarding to the finance business and obviously investing, which will help you to make a better decision, either invest in the cryptocurrency or in the share market or in the stock. We try to give you the idea for the long term and sometimes for the short term as well. But we believe that if investor one can invest for the long term, he will have a better chance uh, to get the better return on his investment. In today's video, I'm going to talk about the investor and the inflation. Obviously, investor means whoever invests in the stock, either in cryptocurrency, and inflation is the inflation is the let's say that the decreasing of the purchasing power, and basically I'm going to give you the video, all of them, and I'm going to most of the things I'm going to talk from the Intelligent Investor, chapter 2 of the Intelligent Investor, which was written by the Benjamin Graham. Um, if you want to get an idea about the chapter 1, we have a video on our YouTube channel. You can always go there and you can watch the chapter 1 to understand the chapter 1 of the Intelligent Investor if you don't have a time to study the whole books. So let's move to the next slide. Uh, okay. Obviously, if you want to contact us, you can always send us email at info@currencyhack.com. And if you want to send it email personally to me, you can send email in my address seeba@currencyhack.com. Uh, Before I move to the next slide, let me tell you one thing, that investing is the obviously investing have a huge opportunity. You can create a huge wealth through the investment, but there is a risk involved in it. So before you invest money, um, uh, never invest money that you can't afford to lose, and always do your own research before investing cryptocurrency and other kinds of shares. Cryptocurrency obviously are subjected to high risks and high volatility, so make sure that you understand the the profitability or the high risks in the cryptocurrency and share market. Here we try to give you the only idea, and we are not recommending you anything. Let's say we are you must see your financial advisor before you take any further action. So let's move to the next slide here. Yeah, as I've told you before that in today's video I'm going to talk about the investor and inflation. Let's read the first paragraph from the chapter 2 of the Intelligent Investor, and I'm going to describe what it means. And uh, if you have any question or thing, uh, the feedback, you can always send us email, or you can type us on, you can give us a feedback in the comment below. That's fine. Inflation and the fight against it has been very much in the public's mind in recent years. The book was written, I believe, that 1971, and it's been in the public's mind regarding to the inflation, and we still have lots of confusion and the Lots of people was thinking about the inflation, the shrinkage in purchasing power of the dollar in the past, and particularly the fear or hope by spectacular of a serious further decline in the future has greatly influenced its thinking of Wall Street. Mm, Obviously, if you don't know about the speculator and the investment, we have an article in our website www.currencyhacked.com. There, you can check the difference between the investment and the speculation. Has greatly influenced the thinking of the Wall Street. It is clear that those with a fixed dollar income will suffer when the cost of living advances, and the same applies to a fixed amount of dollar principal. Holders of a stock, on the other hand, have the possibility that the loss of dollar purchasing power may be offset by advances in their dividend and the price of their shares. Yeah, what is the inflation? Let's talk about the inflation. Inflation is the uh, is the condition where the purchasing power of the dollar or any kind of currency is shrinking in the certain time. Let's say if we have a 2% or 3% inflation in the United States, it means that if you can buy something, uh, uh, from the $100 today, if you was able to buy the things worth of the $100 before 1 year ago, now you can buy the if you need a like use you need $103 to buy the same things in the today's price. It means that the power of the dollar is decreasing. It means shrinkages. So but on the the question is how investor can fight against it, and how they can keep the power of the dollar to purchase the things. I'm going to talk more about it later. So let's move to the next chapter here. Actually, let me go to the previous. Um, Sorry, let me go to the previous. Um, what is our previous slide here? Okay, me- I'm trying to. Okay, let me exit the presentation. Let me have to go to our presentation here. Mm, okay, I think that will do. Mm, on the other hand, investor can invest in the stocks, uh, say index fund or any other kind of business stock, which might have a better chance to get the dividend plus the appreciation on your investment, so that you can you can you can your the purchasing power will stay. So um, that's the one idea investor can use to to investor can use to fight against the inflation. Let me go to the next slide here. Okay, so let me read you the another paragraph here, which was very interesting, and then it might give you the better idea about it as well. So our readers must have enough intelligence to recognize that even high quality stocks cannot be better purchased than bonds under all conditions, i.e., regardless of how high the stock market may be and how low the current dividend return compared with the rates available on bond. A statement of this kind would be as absurd as was the contrary one too often heard years ago, that any bond is safer than any kind of stocks. In this chapter, we We shall try to apply various measurement to the inflation factor in order to reach some conclusion as to the extent to which the investor may wisely be influenced by exception regarding future rise in the price level. The idea uh, is to buy the 50% of the bond and the 50% of the stock in the best time. We mean that in best time is that the when the price of the stock or the index in the substantially low price. Let's say if you get the 30% or 40% margin, maybe you can buy them. And according to the Intelligent Investor Chapter 2, the investor must have a, if you want to, there are lots of, uh, we at the moment we are talking about the defensive investor. So defensive investor means he will have a, he will be, he, let's say defensive investor means he is not risking his any principal, plus he wants continuous income and possibly the fight against the inflation. So to do that, the investor can put his 50% on the stock and 50% on the high quality bond. By this way, he, let's say if the stock goes down, then investor can take out some, can sold some bond, let's say 10% from his bond portfolio, and he can invest in the some stock if he think that the stock uh, is the, is in the bargain price. So and the other hand, if the investor think that stock is already high in the peak price, he might sell the let's say 10% of the stock, and he can move to the bond. That way, the defensive investor, we call it defensive investor, can might possibly fight against the inflation. And he don't need to worry about the loss, about the his principal, and he don't need to worry whether its principal can be substantially, can go down substantially or can go up, like substantially up. So that way the defensive minister can can fight against the inflation according to the chapter 2 of the intelligent investor. Let's go to the next slide here. uh, uh, let's go to the next interesting topic, which which is really, gold mm, has been a, let's say, mm, how can I explain to you, gold has been a, has been in the public mind, and then they have been thinking about the gold, and it will it will it will fight against the inflation. But we also think that gold is the things, it is not producing anything, so it is not giving you the any earning. Let's say if you put some money in the business can give you a return by selling the either the service or either the product, but gold does not produce actually nothing. So um, let me read this in a paragraph here, and after that I'm gonna explain about it, and why gold might not be good to invest to fight against the inflation. The standard policy of people all over the world who mistrust their currency has been to buy and hold gold. This has been against the law for American citizens since 1935. Luckily for them, in the past 35 years, the price of gold in the open market has advanced from $35 per ounce to $48 in early 1972, a rise of only 35%. But during all this time, the holder of gold has received no income return on his capital, and instead has incurred some annual expenses for storage. Obviously, he would have done much better with his money at interest in saving in interest in saving bank, in spite of the rise in the general price level. So it means that the gold is the things, we also believe the same things, because gold is the things and it is not producing anything. In fact, investor is buying the gold by thinking that someone will buy later in the high price. we also believe that the gold might not be good investment to fight against the inflation because of the fact that the things cannot generate anything. Mm, And on the other hand, investor can invest in the gold business, which will give them a continuous dividend plus the possibly capital appreciation on their invested capital. So in the conclusion, we think that the gold might not be good for the investor if investor want to fight against the inflation and the things. And we also believe that the investor um, mm, might need to might need to have a look into the other area, possibly in the stock market, or in the other area to fight against the inflation. So let me go to the next chapter over here. Yeah, and this is the final. Uh, this is the final slide here. This is the conclusion that we can find in the Intelligent Investor book. The you know conclusion what he tried to tell us and what we think about it. Naturally, we return to the policy recommended in our previous chapter. Just because of the uncertainty of the future, the investor cannot afford to put all his funds into one basket, neither in the bond basket, despite the unprecedented high return that bond have recently offered, nor in the stock market, despite the prospect of continuing inflation. So, in the conclusion of this chapter 2, the Pengram is trying to tell us that the investor should put his 50% uh, of the capital in the bond, or and 50% on the stock. Possibly he can invest in the index fund if you wanted to invest for the 20 or next 30 years. We also believe that the investor can have a look in the stock. Uh, we we don't have that much idea about the bond, and if investor want the capital appreciation, maybe we can recommend them they buy a index fund in the bargain price, let's say maybe 10-20% uh, in the discount. Obviously investor might need to wait, or he should have a discipline capacity to wait to get the to get the discount on the index fund. But the stock have a better chance to fight against the inflation. That's the last chapter, and I'm going to talk about the. We have a more sorry, we have a more. I have a more things to talk about the inflation, and I'm going to talk a little bit about the inflation and how investor can fight against it. By reference the intelligent investor. Anyway, if you want to follow us on LinkedIn, you can follow us on LinkedIn by typing the currency hack, or you can go to our Facebook page or LinkedIn, or you can follow us on YouTube or subscribing to our channel to get the more videos regarding to the investment and finance, which will help you to become financial freedom. So that's all for today for the presentation, and let me go to the book here, and let me read the conclusion over here, because uh, it might give you the good sense how it can find the against the inflation, because it's really important to 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 keep the purchasing power of the dollar, or either in your currency. Conclusion. Mm. We've been recommending our viewer and the reader read the intelligent book, Intelligent Investor, because Intelligent Investor book is excellent book, we think, because of the fact not only talk about the how to analyze the business and everything, but it will only it's also talking uh, about the human temptation and the some other um, important things which can happen in the stock. Conclusion. So let me read the conclusion naturally. We return to the policy recommended in our previous chapter. Just because of uncertainty of the future, the investor cannot afford to to put all his funds into one basket. Neither in the bond basket, despite the unprecedentedly high return that bonds have recently offered, nor in the stock market, despite the prospect of continuing inflation. The more the investor depends on his portfolio and the income therefrom, the more necessary it is for him to guard against the unexpected and disconcerting in this part of his life. It is axiomatic that the conservative investor should seek to minimize his risks. We think strongly that the risks involved in buying, say, a telephone company bond at yields of nearly 7.5% are much less than those involved in buying the DJI at 900 or any stock list equivalent thereto. But the possibility of large-scale inflation remains, and the investor must carry some insurance against it. There is no certainty that a stock component will insure adequately against such inflation, but it should carry more protection than the bond component. This is what we said on the subject in our 1965 edition, page 1997. We will write the same today. It must be evident to the reader that we have no enthusiasm for common stock at this level. 892 for the DJIA for the region already given. We feel that the defensive investor cannot afford to be without an appreciable proportion of common stock in his portfolio. Even we regard them is the lesser of two evils, the greater being the risk in an all bond holding. So this paragraph summarize everything. So it means that the investor can buy the bond. We mean that the excellent bond and the stock. Uh, and then he might choose the 50-50%, either 50% in the bond and the 50% in the stock market. So uh, that uh, that's all for this chapter 2 uh, of the intelligent investor. If you have any question or feedback, just don't forget to send us email, or you can comment up below. uh, and if you want more videos something like this, you can also subscribe into our YouTube channel. um, and that's all for today.